Hi guys, welcome to Investing with JYK, and today we'll talk about PAK, the Pakistan ETF. So Pakistan is quite cheap at the moment, and their shares that has gone down from the peak of 19 to like 11, so it's close to half off. And this is at the as low as 2016 during when the whole world was going like, oh, we're going into recession. That's quite cheap. And the yield here says 3.7, but it's actually misleading. So we'll see why that is. And so the main problem with Pakistan at the moment is they have a high debt. They have like 70% debt to GDP ratio for the government. That is very high for a developing country. And the dollar, they have dollar debt. Some of them are dollar debts. And then dollar's been rising. The dollar, the treasury has been increasing. So there's a whole sucking dollar action. So for any economy that is reliant on dollar debt, it's kind of bad. So that include like Argentina, which has recently shown a lot of stress, Turkey, Pakistan, and these countries. China should do mostly fine because China has a net dollar position instead of like a dollar debt. Now, in terms of the fundamentals of Pakistan, obviously there's always a risk of the government pulling back, right? That they're gonna spend less, and the business will suffer in because of less spending. But in terms of the individual businesses, I took a look. So let's just see if I can make this any bigger. So I make it all right. So these are the companies that's found in the PAK ETF. So I went through each one of them, trying to see what kind of PE and PB they have and what kind of dividend they pay. I have not looked into each of them in terms of fundamentals, like what the business does and all that, or what's the advantage, because I simply don't have the time to do it. There's like 20 of these guys. So what I did was I just did their ratios, and here it is. Okay, so I'm going to start from here all the way back to here. So anything above 2%. All right, so you can see this is the PE. PE is 8. The lowest it's been is 3, so 4. So this has some room to go down. Dividend yields 3.6, lower than average, so that means it might have room to go down, but it's been growing every year for the past 5 years. That's nice. So this one is the Mishtamil. I guess it's some kind of flour or something like that. Okay, and then this one is Milat Tractors. Sounds like it's making tractors. And you can see the PB is insane, so there's something wrong with the B here. The PE is 10. Average is, the low in the past 5 years is 9, so it's on the low end for the past 5 years. Dividend yield is higher than average, and growth, dividend growth itself is 12%, very healthy. And this Bank Al Falal, single digit, slightly slightly higher than average. It's actually the highest it has been in the past 5 years. And dividend yield is only 3%. Dividends decreasing. Not nice. Book value pretty low. So the bank's not doing very fine. And here you got a cement company that 50% more than the lowest PE they've in the past 5 years. 5% dividend. It's been growing 38% per year. Very healthy dividend growth. This, I don't know what the hell this thing does. Again, 20 PE. This thing might be some kind of retail, I think. Let's see what they have. Manufacture pharmaceuticals. Holy crap. And consumer products. And sale of food. Okay, so it is a retail plus manufacturing company. Okay, very interesting. Dividend only 2%. Growth, dividend growth has been 100%. Extremely strong in that sense. Some kind of motor company. 9 PE, 30%, 50, close to 50% higher than the 5-year low. Fairly high book price to book, not very nice. But dividend is 7%, lower than average, 5-year average, and then growth rate is 30% dividend growth. Very nice. And the fertilizer here, you got on the low end of the past 5 years, low end of the range, reasonable PB, low PS, dividend yield of 11. No data for those two, no idea why, but 11% dividend yield seems nice to me. This is what? This is another fertilizer company. Yay. Somewhat on the high end of the PE for the past 5 years. PS fairly low, PB reasonable, and dividend yield is 7%. So this is on the low end. So it's somewhat expensive in a sense. Dividend growth is negative. Don't like. Payout ratio seems reasonable. And you got this Pakistan state oil company. Very low PE, but still potentially 50%. And this is oil company, right? So this is a cyclical company for sure. Even those fertilizers. Price to sale extremely low. Dividend yield 6% on the high end. Dividend growth very high. Oil has been going up since 2016, so that might explain a lot of that. Hub Power. I actually want to buy this, but you can't buy it here. I may be able to find some kind of way to buy this individually. I like power companies if they're cheap. This thing is 9, so 10, so mid-range PE. PB is a little high. Dividend yields been growing and slightly on the low end, so somewhat expensive at the moment for its 5-year range. And you got this another oil company. And yeah, somewhat high PE, very high PB for an oil company. I don't like this. So dividend yield is on the low end. Dividend has been declining. Not nice. And what is this? Lucky Cement. Cement company, 12 PE, almost double the 5-year low. PB seems reasonable. Dividend fairly low, but on the high end of the 5-year range and decent dividend growth. And again, here this Angro, forgot what they do. They are an investment holding company, all right. So some kind of conglomerate. Fairly low PB. pretty high dividend yield, and they're paying more than they're taking in. And then you got, what is this? Pakistan Petroleum, another oil company. Low end in their PE, reasonable PB, and reasonable dividend yield. Dividend has been growing for the past 5 years, 8%, reasonable growth. And what do you have here? United Bank, bank, 10 PE, somewhat on the high end of the PE range. Low PB as banks should have. Dividend yield is higher than 5-year average, and dividends been growing. Like another bank, 11, mid-range, mid of the 5-year range, and you got 1.5 PB, somewhat higher than the other one, still reasonable. 8% dividend on the high end of the yield range. Dividends been growing 8% a year, like Habib Bank, another bank. And what do they have? Some crazy PE. Probably have some one-time thing. Their PB is still not very low, so I'm guessing some kind of one-time thing, but yeah, not quite sure what's going on. But this one is actually a fairly large holding. This is 7% of the portfolio. Dividend yield is on the low end. Dividends been growing. Payout ratio is exceeding 100, but I think this is not normal. Some one-time event is happening. Otherwise, it shouldn't be so out of line. And the biggest thing again is an oil company. So what do they have? 9P on the mid of the range, very tight range here. 1.3, reasonable kind of P. 5% dividend on the high end of the dividend yield range, and dividends declining. Okay, so you get the idea. So basically, their companies are paying 5% or more dividend, most of them. And a lot of them have very high dividend growth rates. Most of the company are single-digit PE. PB is all over the place. Is 1 to all the way to like 5, in which is the tractor company. Right, so those are what you're gonna get with PAK. So maybe you wanna wait for more, even better bargain if the thing goes to like 5. Things go to like 5 PE or something. So on average, I think this stuff has around 10 PE-ish. And dividend yield is probably going to be 5% plus overall. And the dividend seems to be growing fairly quickly. And then the biggest worry I have is Pakistan. Debt to GDP is obviously one thing. The other one is inflation. So once inflation picks up, at the moment they're not super high. They're like 4%, so okay-ish. But their exchange rate to dollar will suffer, I think, with the whole strong rupee thing. So Pakistan rupee to USD. If you look at that, and look at this, if we do, and you can see clearly this is controlled. So their central bank is controlling this. So for sure, there is a black market. And that is something that you have to watch out. Every time this thing drops, so this is from USD to Pakistan. So going up means rupee is dropping in value. So if you do 5 years, look at that. It's lost half of its value. So that's the danger here. And it has been, there was a bump, and then that was time when they got the bailout from International Monetary Fund. So it's as high as even higher than that point. So yeah, this is the biggest hidden danger, because when the peg breaks, all hell will break loose. So that's the danger of investing in Pakistan. I have a little bit of money in PAK. It is looking fairly cheap. 10x seems cheap enough. The currency is definitely dangerous. I'll see. But what I like about Pakistan is that China, with its One Belt, One Road thing, is building a lot of infrastructure in Pakistan. They're building a port, building a railroad. All that is basically going to be foreign debt to Pakistan, so it's going to be both good and bad. I think because these are all productive assets, so the Chinese are not giving Pakistanis the money to spend to consume, but to invest. So hopefully these will bring better economic growth going forward. So I think 2016 is when the whole One Belt, One Road thing kicked into fairly high gear, and then China decided to invest 25% of Pakistan's GDP in 4 years. So that'll be 6% of GDP's worth of investment into Pakistan in its infrastructure. And I am hoping that will give them enough of a boost. And once the railroad is constructed, now you have a railroad going directly from the sea to China. So if you look at the Pakistan, somewhere around Karachi, they were building a port. This one here, they're building a port here, and the goal is that China will build some kind of railroad all the way to the sea, probably to Karachi or even to this Gwadar port. Yeah, so let's see. China-Pakistan Railway. How does that look like? Oh, I think I'm right. No, that's not. That's not it. So they're building a highway network all the way to Gwadar. And there's another highway. What about railway? This again a highway. Okay, railroad projects. So there's a bunch of them here going from Islamabad to whatever. Let's see what this is. Okay, so they're not building to Gwadar. Okay, so only to Karachi. So basically the whole thing is going to go from Islamabad to Karachi. And Karachi is the financial and district, the financial center. Islamabad is the capital. So this is like, well, in terms of China, this would be Shanghai and this would be Beijing. But once you link them together, hopefully something will happen, and then I'll make some money. But who knows? It's a very speculative buy. Don't put too much money into it. I put a tiny portion into Pakistan, and Last year, I think distribution was something around 8%. This year, I don't know how much it is. Maybe the currency will collapse. The thing will drop another 50%. So whenever you invest in something like this, be ready to lose 50% in a year. It's a very real possibility. Yeah, so today is mostly just a very rough look at Pakistan. And then if you like the videos, please subscribe, click like. If you don't like it, please click dislike, leave your comments, and I try to respond. See you next time.